You know that feeling, right? You click buy on something from Meesho or Zepto, and boom, before you know it, there's a knock at your door. It's kind of like magic. But have you ever stopped to think about who's actually pulling the strings behind the curtain to make that happen?
Well, there's a really good chance it's a company you might not have even heard of called Shadowfax. They're the ones doing a lot of that heavy lifting. And now, this invisible force is stepping right into the spotlight because they're gearing up for a massive IPO. So today we're going to pop the hood on the Shadowfax IPO and see exactly what's going on.
All right, so here's the game plan. We'll start with who Shadowfax really is. Then, we'll crunch the numbers on this IPO. We'll look at the good stuff, the case for growth, and then, of course, the big red flags. And we'll wrap it all up by asking the million-dollar question. Is this just a high-risk bet? Let's do it.
Okay, first up, the company behind your order. So, who exactly is Shadowfax? Like I said, you've probably never heard the name, but I can almost guarantee you've used their service.
Get this, they are India's largest third-party player for same-day delivery, but they also handle something called reverse logistics. So what does that mean? Well, think of it like this. When you order from, say, Flipkart, they hire Shadowfax to be the delivery expert, the one who gets that package to your door at lightning speed. And reverse logistics? That's just the whole journey in reverse. It's the messy, complicated process of you returning an item and them getting it all the way from your house back into the warehouse. They're the masters of both directions.
All right, let's get to the juicy part, the IPO itself. We're going to break down the numbers, because trust me, they tell a really big story about where this company is headed.
So, the total size of this IPO is a whopping 1,975 crore rupees. That is a huge chunk of change. It's a massive signal about their ambitions, but the big question is, where is all that money actually going? Okay, so this is really important to understand. The IPO is split into two parts. About 1,000 crore is what's called a fresh issue. Think of this as brand new money going directly into Shadowfax's pocket to fuel its growth. The other part, 975 crore, is an offer for sale. That's where existing investors are selling off their own shares and cashing out. So it's pretty much a 50-50 split between money for the company and money for early backers.
So what are they going to do with that fresh 1,000 crore? Well, they're laying it all out for us. A massive piece of the pie, over 42%, is going straight into beefing up their sorting machines and tech to get faster and more efficient. The rest is split between building new delivery hubs, a bit of marketing, and just general operations. It's pretty clear they are pouring fuel on the fire to scale up, big time.
Okay, so that's the plan. Now let's switch gears and look at the bull case. Why should you be optimistic? There are a few really powerful reasons to believe this company could be a huge success story.
First off, just look at this chart. Their market share in express delivery has absolutely exploded, jumping from a mere 8% all the way up to 23%. Now, this isn't just them riding a rising tide. No, they are growing way faster than the rest of the industry. That screams that they're doing something right.
Now, to really get a sense of their secret sauce, we need to talk about a metric called the capital turnover ratio. I know, it sounds super technical, but the idea is actually dead simple. It just measures how good a company is at using its stuff, its warehouses, its vehicles, its tech, to actually generate sales. And for this ratio, the higher the number, the better.
And wow, check out Shadowfax's number. It's 3.96. Let me put that in perspective for you. For every 1 rupee they have in assets, they are generating almost 4 rupees in revenue. That is just incredibly efficient. It tells you they have a very lean, asset-light model that's just humming along.
But honestly, this next point might be the biggest deal of them all. For years, this company was losing money, a lot of it. We're talking 142 crore loss just last year. But now, they've officially turned the corner. For the first time ever, they've posted a profit. Yeah, it's a small one, just 6.4 crore, but that shift, from burning cash to making cash, that is a massive, massive milestone for any growth company.
All right, so things are looking pretty good, right? But hold on, we have to be balanced here. Every exciting growth story has a flip side, and Shadowfax has some pretty big red flags that you absolutely have to know about before you even think about investing. Okay, this one is huge. It's what we call client concentration. Nearly half, we're talking 49% of all their revenue comes from just one customer. Let that sink in. If that single massive client decides to, say, build their own delivery arm or switches to a competitor, poof, Shadowfax could lose almost half its business in the blink of an eye. That's not just a risk, that's a potential company killer.
And the worries don't stop there. You can't just forget about that long history of losing money. Plus, remember that reverse logistics thing?
Handling returns is super expensive, and every damaged parcel chips away at their profit. And, when you put them side by side with some of the bigger players in the space, the revenue and profit numbers still look pretty small. It's a good reminder that this is very much still a high-growth, early-stage company.
So here's where we are. A super efficient, fast-growing company that's finally making money, but is also walking a tightrope with some major risks. So how does all of this factor into the price? Let's talk about the final piece of the puzzle, valuation.
So this brings up a tricky question, right? How on earth do you value a company that just barely squeaked into profitability? Your standard go-to metric, the P/E ratio, is kind of useless here. Because the E, the earnings, is so tiny, the PE ratio would be sky high and make the company look ridiculously expensive. That's not really the full picture. We need a different yardstick for this one.
And that's where the market cap to sales ratio comes in. It's a much better tool for a company like this. Instead of looking at profits, it just compares the company's total price tag to its total annual sales. This gives you a much more stable view of a company that's all in on growing its revenue right now.
So what's the number? Well, post-IPO, Shadowfax is expected to have a market cap to sales ratio of about 1.45. And when you stack that up against its peers in the logistics world, that's actually considered pretty reasonable. It doesn't scream overpriced, especially when you factor in how fast they're growing.
So really, if you had to sum this entire IPO up in one line, this quote nails it. This is the textbook definition of a high-risk, high-growth story for investors. The upside could be huge, but man, the challenges are just as real.
And that's really the core dilemma here, isn't it? On one hand, you've got explosive growth, they're finally profitable, and the valuation seems fair. But on the other hand, you have that scary dependence on one client and a long history of burning cash. It's a classic investment tug-of-war.
So that leaves us with one final thought. The next time a package shows up at your door in what feels like minutes, and you think about that invisible machine that made it all happen, the question is, will you just be a happy customer, or will you be an investor?
Now, just a reminder, of course, everything we've talked about today is just to help you understand the company and the IPO better. It's for educational purposes only, and it's definitely not investment advice. You absolutely have to do your own homework and decide what makes sense for you.